Imagine for a moment you're at a casino. You sit down at the blackjack table ready to play. But here's the twist. Unbeknownst to you, the dealer has a hidden advantage. A secret computer program that can see your cards and make decisions faster than humanly possible. Every time you make a move, they're already one step ahead. Sounds unfair, doesn't it? Welcome to the world of high-frequency trading, where Wall Street titans have replaced casino dealers, and the game is rigged against ordinary investors like never before. High-frequency trading, or HFT, isn't a term most people are familiar with, but it's a practice that impacts every single one of us. At its core, HFT is about speed, using sophisticated technology to execute trades in microseconds, giving those who can afford it an unfair advantage over everyone else. It's like letting Usain Bolt start running 20 meters before the starting gun goes off in a race. The origins of HFT trace back to the early 2000s when firms like Tower Research Capital and TradeBot began exploiting tiny price discrepancies across different exchanges. These disparities, measured in fractions of a penny, add up quickly when you're executing millions of trades per second. By some estimates, HFT now accounts for over 50% of all equity trading volume in the US, generating billions in profits annually. But how does this hurt regular investors? Well, consider what happens when a large institutional investor wants to buy or sell a significant number of shares. Their order can move the market, causing prices to swing unfavorably. HFT firms exploit this by front-running these orders, buying up shares ahead of the institution and selling them back at a higher price. The result? Regular investors pay more for their stocks, unaware that high-speed computers are playing a zero-sum game with their savings. The story of high-frequency trading, or HFT, is a tale of innovation and exploitation that dates back to the early 2000s. At its core, HFT involves using sophisticated algorithms and high-speed computers to execute trades in fractions of a second, enabling firms to front-run large orders from institutional investors. But how did we get here? The roots of HFT can be traced back to the late 1990s when the Securities and Exchange Commission introduced regulations aimed at increasing competition and reducing transaction costs in the US equity markets. One such rule, Regulation Alternative Trading Systems, allowed for the creation of alternative trading systems, or dark pools, which could operate outside of traditional stock exchanges. These new platforms attracted HFT firms, who saw an opportunity to profit from the slightest market inefficiencies. By placing their servers directly inside the data centers of these exchanges, they gained a critical edge in terms of latency, the time it takes for a trade to be executed. This practice, known as co-location, allowed HFT firms to receive and act on market data faster than their competitors, giving them an unfair advantage. As HFT grew in popularity, so did its impact on the markets. In 2010, the world witnessed the infamous flash crash, where the Dow Jones Industrial Average plummeted nearly 1,000 points in a matter of minutes before recovering just as quickly. The SEC attributed this event, in part, to HFT strategies gone awry. Despite mounting evidence of the dangers posed by HFT, these firms continued to amass wealth and influence on Wall Street. In 2015, it was reported that just 5 HFT firms accounted for over 40% of all US equity trading volume, generating billions in profits while leaving regular investors in their dust. Today, HFT remains a contentious issue, pitting those who see it as a natural evolution of financial markets against those who view it as little more than legalized front-running. But one thing is clear, the rise of high-frequency trading has forever changed the landscape of Wall Street, often at the expense of regular investors. At the heart of high-frequency trading, or HFT, is a combination of cutting-edge technology and sophisticated algorithms designed to exploit the tiniest market inefficiencies at lightning speed. The exchanges that facilitate this legal arms race, such as the New York Stock Exchange and NASDAQ, rent out space within their data centers to HFT firms for a premium. This practice, known as co-location, allows these firms to reduce latency by installing their servers mere feet away from exchange servers, a significant advantage when every microsecond counts. One such firm is Virtu Financial, which boasts that its technology-driven trading strategies generate profits in 96% of all trading days. In 2017 alone, Virtu raked in over $750 million in revenues. Another prominent player is Citadel Securities, an HFT powerhouse that handles roughly 20-25% of daily US equities trading volume. The algorithms these firms use are shrouded in secrecy, but generally involve complex mathematical models and machine learning techniques to analyze vast streams of market data in real time. By detecting patterns and trends before others can, HFT firms can place trades at lightning speeds as fast as 10 microseconds, giving them a crucial edge over slower investors. But how does this translate into profits? Picture this. An institutional investor like Fidelity or Vanguard wants to buy large quantities of stocks in a particular company. To minimize market impact, they'll typically split their order into smaller chunks and release them gradually over time. HFT firms, using their advanced technology, can detect these orders the moment they hit the market and front-run them, placing their own buy orders ahead of the institutional investors to drive up the price, then selling those shares back to the investor at a higher price. This practice, known as order anticipation, isn't just unethical, it's illegal. Yet with HFT firms operating in a regulatory gray area, it remains a persistent problem plaguing modern financial markets. And while high-frequency trading has undoubtedly contributed to the growth and efficiency of Wall Street, its benefits are largely reaped by a privileged few at the expense of regular investors left struggling to keep up. As we delve deeper into the world of high-frequency trading, or HFT, it's crucial to examine the hidden costs of this controversial practice. While HFT firms and their enablers on Wall Street may reap substantial benefits, regular investors are often left paying the bill. First, consider the exorbitant fees associated with HFT. According to a 2020 report by the financial research firm Tab Group, high-frequency traders pay an average of just 0.009 per 100 shares traded, a fraction of a cent. In contrast, regular investors are charged anywhere from 4.95 to 10 or more per trade by popular online brokerages like E-Trade and Robinhood. But the real costs of HFT extend far beyond fees. By engaging in practices like order anticipation, these firms effectively manipulate the market, creating an uneven playing field that puts regular investors at a distinct disadvantage. In 2010, for example, the SEC fined the HFT firm Trillium Capital $1 million for placing and canceling orders to probe for hidden liquidity, all while claiming they were doing so to improve market efficiency. Meanwhile, studies have shown that HFT can exacerbate market volatility, imposing additional costs on regular investors. A 2017 paper published in the Journal of Finance found that high-frequency traders can amplify price movements during times of market stress, making it more difficult for long-term investors to buy and sell assets at stable prices. So who's fighting back against this high-speed arms race? Some institutional investors have taken matters into their own hands, forming groups like the Investor Stewardship Group to advocate for greater transparency and accountability in financial markets. The ISG's principles for stewardship emphasize the need for long-term investment strategies that prioritize sustainable value creation over short-term gains, a direct contrast to the high-frequency trading mentality. Yet, despite these efforts, HFT continues to thrive in a regulatory gray area, leaving regular investors to bear the hidden costs of this high-stakes game. As we'll explore in the next segment, the fight for greater transparency and fairness in our financial markets is far from over, and it will take all of us working together to ensure that regular investors aren't left holding the bag. While high-frequency trading, or HFT, may seem like a technicality on the surface, its darker side reveals a more sinister reality. Flash crashes, manipulation, and front-running are just some of the controversial practices that have put HFT under scrutiny. On May 6, 2010, the Dow Jones Industrial Average plummeted nearly 1,000 points in a matter of minutes before recovering most of its losses over the next hours, an event known as the flash crash. The Securities and Exchange Commission later attributed this market chaos to high-frequency trading algorithms gone awry. This incident exposed the vulnerability of our financial markets to HFT-induced volatility, leaving regular investors in a state of panic and uncertainty. Moreover, HFT firms have been accused of manipulating stock prices through a practice called spoofing. In 2015, Navinder Singh Sarao, a British day trader, was arrested for using spoofing algorithms to artificially manipulate the market, earning him millions of dollars. Sarao's actions contributed to the infamous flash crash of 2010, revealing just how deeply HFT is entangled in financial misconduct. Front-running is another illicit practice that HFT firms have been accused of. By placing their servers in close proximity to stock exchanges, these firms can receive and act on market information mere microseconds before the rest of the market. This advantage allows them to trade on this information ahead of larger orders, capitalizing on even the smallest discrepancies in price. In 2014, the SEC charged a New York-based trading firm, Athena Capital Research, with front-running, resulting in a $1 million penalty. Despite these high-profile cases, HFT continues to operate in a regulatory gray area. The fragmented nature of our financial markets and the complexity of HFT strategies make it difficult for regulators to enforce existing laws and deter bad actors. As a result, regular investors bear the hidden costs of this high-stakes game, often unknowingly footing the bill for market manipulation and predatory practices. In the next segment, we'll explore the fight for greater transparency and fairness in our financial markets. The battle is far from over, and it will take all of us working together to ensure that regular investors aren't left holding the bag. Regulatory bodies have been trying to rein in high-frequency traders for years with mixed results. In the United States, the Securities and Exchange Commission, or SEC, has taken some steps to address the issue, but critics argue that these efforts haven't gone far enough. In 2014, the SEC proposed a rule that would require high-frequency traders to disclose more information about their activities. The idea was to increase transparency and give regulators a better understanding of how these firms operate. However, the proposal faced strong opposition from the industry and was ultimately withdrawn. The Commodity Futures Trading Commission, or CFTC, has also tried to crack down on high-frequency trading. In 2013, the agency proposed new rules that would require high-frequency traders to register with the CFTC and follow certain risk management practices. However, these rules have yet to be finalized, and in the meantime, high-frequency traders continue to operate with limited oversight. Meanwhile, in Europe, regulators have taken a more aggressive approach. In 2018, the European Union implemented new regulations known as MiFID D2, which require high-frequency traders to disclose more information about their algorithms and trading strategies. The rules also limit the use of certain practices, such as spoofing, which involves placing fake orders to manipulate market prices. Despite these efforts, high-frequency traders continue to find ways to game the system. In 2019, for example, it was revealed that a group of high-frequency traders had colluded to manipulate the price of certain stocks. The firms involved paid millions in fines, but the damage was already done. Critics argue that regulators need to do more to protect regular investors from predatory high-frequency trading practices. Some propose creating a separate exchange for retail investors, where high-frequency traders would be banned. Others call for stricter penalties for violations of market manipulation rules. As the fight for greater transparency and fairness in our financial markets continues, it's clear that there is no easy solution to the problem of high-frequency trading. But one thing is certain, regular investors deserve a level playing field, and it's up to all of us to ensure that they get it. 2010, the flash crash. A staggering $1 trillion vanished from the US stock market in just minutes, only to reappear just as suddenly. The Securities and Exchange Commission launched an investigation, and what they found was shocking. At the heart of this disaster were high-frequency traders, using complex algorithms to exploit market inefficiencies at lightning speeds. One firm, Infinium Capital Management, was fined $1.8 million for its role in manipulating the closing prices of thousands of stocks during this chaotic event. But it didn't end there. In 2015, a group of HFT firms, including Tower Research Capital and Junk Trading, were accused of front-running, placing trades ahead of large orders to profit from anticipated price movements. This practice is illegal but notoriously difficult to detect. In another example, the infamous Flash Boys case in 2014, a group of traders led by Brad Katsuyama exposed a scheme where HFT firms were gaming the stock market using secret fiber optic lines between exchange data centers. This allowed them to receive information fractions of a second earlier than other investors, enabling them to make profitable trades before the rest of the market even knew what was happening. These examples highlight the disturbing reality that high-frequency traders can and do manipulate markets for their benefit, often at the expense of regular investors. According to some estimates, HFTs may be taking as much as $5 billion a year from other market participants. Despite these damning revelations, many argue that not enough is being done to curb this behavior. While there have been fines and sanctions, they often pale in comparison to the illicit profits made. Moreover, with technology continually advancing, detecting and prosecuting such activities becomes increasingly challenging. As we move forward, it's clear that maintaining a fair and transparent market requires constant vigilance and robust regulation. Regular investors deserve nothing less. In the shadows of Wall Street, high-frequency traders are making off with billions of dollars, leaving regular investors in their wake. The Securities and Exchange Commission, tasked with maintaining fair markets, has struggled to keep up with these lightning-fast transactions. Fines and sanctions have been levied, but they often amount to a slap on the wrist for these deep-pocketed actors. Take, for instance, the case of ATD Capital Management. In 2014, this high-frequency trading firm was fined a mere $2.8 million by the SEC for misleading customers about the risks associated with their investment products. This fine is a drop in the bucket compared to the estimated $200 million in profits ATD made from its deceptive practices. Or consider the notorious case of Sergei Aleninkov, a former Goldman Sachs programmer who stole proprietary high-frequency trading code and attempted to sell it to a rival firm. Aleninkov was sentenced to 8 years in prison, only to have his conviction overturned on appeal. He now works as a network engineer, while the secrets he tried to sell remain a mystery. As technology advances, detecting and prosecuting high-frequency trading abuses becomes increasingly difficult. The complexity of these algorithms, often shielded by layers of non-disclosure agreements and legal loopholes, makes it nearly impossible for regulators to discern illegal activity from legitimate trading strategies. But there are steps regular investors can take to protect themselves in this volatile landscape. One such measure is to invest in index funds or exchange-traded funds, which offer broad market exposure and are less susceptible to the whims of high-frequency traders. Additionally, investors can demand greater transparency from their brokers and financial advisors, pressing them to disclose any potential conflicts of interest or ties to high-frequency trading firms. The future of high-frequency trading remains uncertain. With each new technological advancement, the potential for illicit profits grows. But as we've seen time and again, unchecked greed and deception can have dire consequences for both individual investors and the broader market, As responsible citizens and consumers, it's our duty to demand a financial system that works for everyone, not just those with the fastest computers and the slickest algorithms. In the end, the battle against high-frequency trading is not just a fight for fair markets, it's a fight for the very integrity of our financial system. And as investors, we must remain vigilant, informed, and engaged if we hope to prevail in this ongoing struggle. The future of our investments, and indeed our economy, may well depend on it.